Welcome to the world of finance. Too many, the stock market looks like a complex web of numbers and flashing lights. But it is built on a simple idea. Every single day, billions of dollars flow through digital networks, connecting buyers and sellers from every corner of the globe in a heartbeat. Think of it like a local farmer's market. People bring what they have to sell, and others come with cash to buy what they need. The stock market is essentially that market, but for pieces of companies. Today, we are breaking down exactly how this massive system functions. So, what exactly is a stock? Imagine a successful company that wants to grow. It needs money to develop new products or expand into new cities. To get that money, they divide the ownership of the company into thousands or even millions of tiny puzzle pieces. These pieces are called shares. When you buy a stock, you are buying one of those pieces. You become a partial owner, which gives you a claim on the company's future. This process allows companies to raise huge amounts of capital for expansion without having to take on massive debts from a bank or lender. But where do these trades actually happen? This is where the stock exchange comes into play, acting as the heart of the financial system. The exchange acts like a high-speed matchmaker. It connects someone who wants to sell their shares with someone else who is looking to buy them. In the old days, this meant shouting on a crowded floor. Today, it happens in milliseconds through a network of powerful computers and servers. You often hear about major indices like the S&P 500 or the Dow Jones. Think of these as barometers for the entire economy's health. They track the performance of a specific group of stocks, giving investors a quick snapshot of whether the market is moving up or down. This constant data transmission ensures that the market remains liquid, meaning you can usually sell your stocks whenever you need the cash back. But why do stock prices change? It is not random. It all comes down to the most fundamental law of economics: supply and demand. If a company releases a revolutionary new product and everyone wants to own a piece of it, the demand for that stock, with many buyers and few sellers, the price is pushed higher. Conversely, if a company is struggling, investors might want to sell their shares. When the supply of shares for sale outweighs the number of people who want to buy them, the price will naturally begin to fall. External factors also influence these prices. News headlines, global events, and even weather can impact how investors feel about a company's future. Earnings reports are critical. Every few months, public companies reveal their profits. High profits usually mean a happy market and rising prices. It is a constant seesaw between two things: the actual performance of the company and the emotions of the investors who trade it. Fear can cause panic selling even when a company is healthy, while optimism can drive prices far beyond what a company is currently worth. While the market can be a roller coaster in the short term, successful investors often focus on the long-term horizon of many years. Historically, despite crashes, recessions, and dips, the overall trend of the global stock market has been consistently upward over time. Think of investing like planting a digital tree. It requires patience, a bit of care, and most importantly, the time to let it grow. Through compound growth, even small amounts invested today can blossom into a substantial financial future as the years go by. The stock market is one of the most powerful tools ever created for building wealth. It is open to almost anyone willing to learn. So, take the first step today. Start learning, stay curious, and begin your journey toward financial independence. Start investing now.